posted the link to that in the chat box. And the one Wealth for Life, which will be coming shortly, the link will be a bit later. And again, that's the one where there's a whole, what do you call it, chapter dedicated to self-managed super funds. In terms of me, so I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with 17 years experience. And that last stop point there, I've already mentioned. So the author of those two books, Wealth for Life and It's All Sorted. And there is a photo of my beautiful family. All right. So why we're sharing this today, I've been doing accounting work and stuff with SMSFs. I'm pretty sure since I was 18. When I started at KPMG, I was auditing them. That sounds a bit dangerous, an 18-year-old auditing self-managed super funds, but that's what they got me to do. And I've been a member of an SMSF since 2011. About 60% of Inspire's SMSFs hold some sort of property with SMSFs. That's a big reason why people might choose self-managed super. And in terms of what percent of our clients actually have an SMSF, that's just over a quarter of them. So 28% or so of our client base actually has these SMSFs. But I've also been an advisor on many transactions involving self-managed super. So things like property purchases, business purchases, can I do X, Y, or Z with my SMSF? All of that sort of stuff is, what I'm very familiar with. And usually if there's a will, there's a way to do it. There's usually a few ways, but it's working out what the best thing is for the client and, sharing that one or a few options to get the transaction done. In terms of just some statistics on SMSFs, it's unfortunately the ATO doesn't publish these as often or as up to date as they usually do. I couldn't find really up to date numbers around this. But if we have a look at the year ended 2023, June 23, we see 27,000 establishments of SMSFs. Yes, there's wind-ups that happen each year, but that's about half. Half as many were wound up than were set up. And so we're looking at a net establishment of 14,000. So even over these last sort of few years that are in the graph here, we can see that there's more and more people getting into SMSFs, and ballpark of about 1 in 20 Aussies in a self-managed super fund with that 1.1 million people statistic. In terms of the average and median balance, this one might be a little bit hard to see on the screen, but average assets per member in 2021 was just shy of $800,000, and the average assets per SMSF was just under 1.5 mil. So the other thing is about 80% of super funds have $2 million or less in their fund. So it's not like you need like 5-10 mil to have one of these things. They can be pretty handy even with, relatively smaller balances when we're thinking of millions. And I know I call this, become an SMSF millionaire, but the whole goal is over your lifetime to pop away so that you might actually have a mil or more in your SMSF by the time you hit retirement. And I also mentioned Wealth for Life. So one of those chapters in the Wealth for Life book is called Long-Term Wealth, but it is all about self-managed super. And if you did want a copy of that book, which has some of the stuff I'm sharing and it goes into a bit more detail, then you can get a copy at our website using that QR code or a link that Tay might post any sec. Alrighty, so what we're going to cover next is sort of 8 rapid fire benefits of a self-managed super fund. So I mentioned all 8 first, and then we'll go one by one into them. So the first one is engagement with your super. We talk about being a family fund, being able to control tax, have an investment strategy, leverage, which I'm talking about sort of funding, leveraging other people's money. Insurances is the next one, and incapacity planning. And the last one there is estate planning. So we're going to go through each of these in a touch more detail. And again, feel free to just pop any questions you've got in the chat box. But again, we will have a time at the end for Q&A. So engagement. I might sort of kick off, and this is rhetorical. I don't need people to respond, given this is fairly personal info. Are you able to answer these questions? How much do you or your spouse have in super? Could you answer that at least to the nearest grand or 10 grand? Which fund is it in? Is it in more than one? If it's in more than one, why is it in more than one? Are you aware of how much it's making? Someone boldly popped their balance in there. You didn't have to, sorry, Michael. Is the fund that you're invested in or through making a return that you're happy with? So what I'm looking at here is from an engagement perspective, can you actually answer those questions? Are you engaged with your long-term wealth, your superannuation? And what I found is clients who have an SMSF are actually more engaged because you have to be. It's called self-managed for a reason. It's not left to someone else to go and choose what it's invested into, and it's on you as the person running that SMSF to manage it. And the other one is the old break even. So a lot of the question is, well, when's it worth it? When's it worth setting up an SMSF? A lot of that reverts back to, what are the fees from my current super fund compared to an SMSF? There's a ton of information and a process to go through to compare one to the other. My perspective on that is I feel like it's more about what you want to do with your super in an SMSF, and that needs to add relevance. For instance, I haven't seen a non-self-managed super fund offering the ability to own property directly. So you can't go and buy a house or a commercial property being a member of a corporate super fund. So I think they're the more relevant questions. Obviously, cost is definitely a consideration, but these are the maybe a better question is what do you want to do with it, and then compare those two scenarios. Alrighty. And I've already mentioned this, the SM in SMSF is self-managed, so it requires diligence in the setup of it and also to run it as well. There's compliance requirements. There's things if you don't do properly or you intentionally do the wrong thing, there's some serious penalties for that. And there is currently an annual audit by a third party required. So they were looking at reducing that to every 3 years to reduce the compliance burden. But at the moment, that is staying at an annual audit. Alrighty. Next topic here is being a family fund. So SMSFs as of 1 July 2021 can have 6 members. Now, there's pros and cons to this, and I'll share those over the next few slides. One of the pros is that 6 people's balances is better than one. You can sort of potentially buy more, or if you're looking to buy property, you have a bigger deposit. But there's things to be careful of. So call them the 3 Ds. We've got death, if a member dies, disability, or if someone becomes incapacitated, or divorce. So when one of those 3 Ds happen, then the person related to that superannuation balance needs to be dealt with. And it may become tricky, especially that last one there, divorce. Let's say you've got mum and dad, 2 kids and their 2 spouses in the fund. That's 6 members. And one of the in-laws gets separated from the one who's family. Now you've got to exit a member potentially, if that's what the decision is. And then that can get a bit tricky, involve lawyers. If you've got property in there as well that's not terribly liquid and you don't have enough cash to pay out a balance, that's where we can start to see, some situations that might not be impossible to work through, but can just be unideal. So, again, I share the idea of the 6-member fund. We've never worked with a client who wants that. Most of our clients will have 2 members in their fund, sometimes 3 or 4 if it's 1 or 2 of the parents getting involved. But usually we don't go to 6, but you can. More people is more decision makers, but we can reduce the risk or the Yeah, there's a type of deed that we can set up called a leading member fund. It basically puts one person in charge where you do have, let's say, more than your spouse, whether you've got a parent or a child. It still gives you a little bit more control than a deed that does not talk about a leading member. So that's a way that we can mitigate the effect of having, more than two members. And we can convert existing SMSFs over to a leading member fund as well. So if you've already got one, it's not like you have to throw out what you've got or transfer all the assets over. We can change the deed to make it one. Alrighty. The next one here is all about controlling tax. And just a quick overview here. Individuals pay up to 47% tax. Companies, if it's a small business, we're looking at 25% tax, or if it's investment only company, 30%. A trust, they don't pay tax. They give it to other people or entities in the family group who end up paying the tax for the trust. And then SMSFs over on the far right, we've got a tax rate of 15% or 0%. Now, that 0% is a legitimate 0%, not like the trust, which is a bit of a trick. But when we're looking at SMSFs, that 15% tax rate is applicable when you are accumulating your balance in super. Throughout your lifetime, most of your life, you will be in what we call accumulation mode. And then when you are drawing down on your super, that's what we call pension or pension mode. And it is taxed at 0%. Now, there was a limit that's brought in on the number of assets that can be treated as 0% tax, and then the rest of it is reverted to the 15% tax rate. And I think it's about 1.6, 1.7 mil. It's per member though, not per fund. So if you've got you and your spouse, you're looking at over 3 mil before you start 3 million investments or assets before you start paying any tax on that on the investment returns it provides. Yeah, benefits of drawing a pension, obviously tax-free investment profits, but also tax-free capital gains tax. So in a fund, let's say you purchase a commercial property when you're 40 and you hold on to that for 25 years, you're now 65 years old. If you bought it at $1 million, sell it at 2 mil in the right conditions, you're in a pension mode, you're looking at 0% tax on that CGT capital gains tax outcome there, which, if you compare that to owning an asset outside of super, trust or a company or your own name, you'll be looking at a lot more tax. So it can be very good, especially with long-term investments. And where we usually see that is where a business owner wants to buy their commercial premises and they know that they're in it for the next 10, 15 years to build and sell that business, then they can retain the commercial property or sell it. But if they're in that retirement mode, pay little to no tax. Q. And it looks like that is showing okay on my screen. But just walking through this comparison, we've got three scenarios here. What it is, it's a starting balance of $100,000 of money invested. The return on that money is 8%. And then the annual contribution. So this assumes that this family group is contributing $55,000 before tax into one of three options. Now, the first option is a bucket company, taxed at 30%. There's accumulation mode in a super fund, and then there's pension mode in a super fund, paying 0% tax. Now, I might say as well, on that $55,000 annual investment in this thing, both accumulation mode and pension mode is taxed at 15% on that contribution. I said earlier that pension mode is 0%, but that means 0% on the investment earnings, not necessarily concessional contributions, which is this $55,000 each year. So I just wanted to clarify that as best I can here. And basically what the outcome is over the 10 years, the difference in tax between these three options, I mean, let's compare bucket company to accumulation mode. You're still looking at $162,000 over 10 years. That's significant. But then if we look at the bucket company to pension, we're looking at over 200 grand in difference there, depending on how we invest that. So, yeah, it sort of says a lot here that, yeah, self-managed super or superannuation in general is a fantastic tax environment for long-term wealth creation. All right, next topic we're going to talk about is the investment strategy. So this is a requirement of an SMSF, and it needs to be kept up to date. It should be reviewed annually, and things it should consider is the risk of the investment or investments that the fund is in, diversification and benchmarks. And that doesn't necessarily need that doesn't mean that you need to have diversified assets, but it needs to be considered. We've got clients with even just cash balances in their SMSF, or property is 95% of the fund and 5% cash. That does not sound to me like it's diversified, but the investment strategy needs to consider diversification in the bigger picture of that SMSF and the family's wealth as well. For instance, let's say they're all in ASX listed shares in the SMSF. Again, that doesn't sound diversified, but if there's a heap of property outside super, then that might make sense from an overall diversification perspective. You also need to set benchmarks for classes of assets as well in the investment strategy. What you expect the return to be. You need to note down if there's any borrowings in super. I'll talk to that shortly, but we need to consider that in the investment strategy. Insurances, and that's for each member. And then liquidity and cash flow requirements. So if there's pensions to pay or ongoing expenses to cover, these are the things that it should consider. And it isn't a set and forget thing. Ideally, it's reviewed each year or before big changes to the investment mix in an SMSF. The other couple of things with investment strategies is make sure they're permitted under the trust deed. There are some assets that an SMSF cannot make, and that's changed over the last 10, 20 years. And then, not prohibited investments by the SIS Act, and then also meets the sole purpose test, which is essentially the golden rule of self-managed super. Now, the sole purpose test basically says that your fund needs to be maintained for the sole purpose of providing retirement benefits to your members or to their dependents if a member dies before retirement. Now, some examples that I learned when I was learning about this is, and some of these are silly, some of them are obvious, but I'll start with an obvious one. If you buy a residential rental property and then with your self-managed super fund, and then you move into it and live in it, that is not for your benefit of your retirement. That's for your benefit of now. And you can't do that. You can't buy residential property and then have you or a related party of you live in that property. And then I'll share another example of breaching the sole purpose test, which is a silly one. But if there was a self-managed super fund that purchased some sort of property near a golf course and actually included a golf membership as part of the benefits of owning that property. Now, one of the members used that golf membership, and that was seen as a breach of the sole purpose test because it wasn't solely for the benefit of retirement. There was some benefit there that was non-related to retirement. Alrighty, we've had a couple of questions pop up on the chat box. So we'll start with Liz's. Is there any way to calculate rate of return on your super? So it's basically just looking at most super fund statements that issue will show your percent return. But then what you should also look at is the percent return net of fees. That's another thing to consider. And you may have to manually calculate that one. John's asked, can you lease it to a company that you own? You can't with residential property, but you can with commercial property. So commercial property you can own or occupy, or a related party of yours can occupy. So and we see that lots. Very handy to secure long-term tenancies for people's businesses. Alrighty. Now we're going to talk about leverage or borrowing with super. And it's a weird concept, but a self-managed super fund cannot borrow to buy anything directly. It's got to, I don't even understand why they introduced this complexity rather than just let them borrow under the same rules. But anyway, we've got to put this thing called a bare trust in between the asset you're buying and you're borrowing on and the SMSF, and technically the bare trust owns that asset until it's paid off. And it's a shadow entity. The property actually goes into the bare trust's name, but the SMSF in practice pays all the bills, receives the rent, and all that sort of thing. Now, a bare trust can borrow money from a bank, but it can also borrow money from yourself, like a bucket company. If you've got excess cash built up in a bucket company, you can lend even to your own SMSF to then purchase through a bare trust to then purchase a property. Yeah, cool. Now, if we look at lending outside of super, for instance, your own name or through a company or trust, it's less complex lending, although it's usually covered. The rules that it's under is the NCCP. It's basically, there's a whole heap of protection for consumers in those sort of structures for residential property. So I say it's less complex, although there's a lot more rules that the banks have to comply with. Borrowing assets outside of super or investments will always have a higher tax outcome. Business or personal income to service. So yeah, sometimes you'll need this depending on your circumstances, but if you need business or personal income to service the property purchase, you may have to have that outside of super. But most banks will look at, like, let's say you're paying rent to a third party right now, but you want to buy your own premises. They will usually look at the rent you're paying and potentially include that as part of your serviceability. And then the other benefit of outside of super that you can't get inside is that you can use the equity in a property outside of super. Most banks will do this. You can use the equity in a property to go lend as a deposit for another one. That cannot happen with the style of lending that's available in self-managed super. Now, inside or outside of super, you can own or occupy if it's commercial. Obviously, residential, you find occupy if it's outside of super. And then also LVRs, loan to value ratio. They go higher than 80% outside of super pretty easily. But even inside of super, we see loans that go up to 80% LVR, which is pretty decent. Where you only need a 20% deposit plus stamp duty and your costs to close on that. Now, if we look at inside super, it's called this LRBA lending structure. In terms of how the banks normally assess the income to service the debt on the property, they usually look at the superannuation contributions that have been paid to the fund, or even if you don't have a super fund yet, you can get a borrowing capacity check by even having your existing super, non-SMSF, looking at what the contributions have been over the last couple of years, but also the rental income that's expected to be earned off that property. Taxes at 15% or 0%, depending on if you're in accumulation or pension. You've got a very limited choice in lenders, though, in self-managed super. So there's two that are big in the market, and I'm pretty sure there's a few others who are getting back into it or trying to take some of the market share. PS, I'm not a mortgage broker. I was, though, a few years ago. But if you do want any detail on this stuff, then a mortgage broker who deals with self-managed super is the way to go. You'll typically pay a higher interest rate in an SMSF, and then the lender can require you to get legal and financial or all financial planning advice. Basically, they're looking to de-risk themselves from a pretty hectic transaction, and what they want you to do is make sure you go and talk to a lawyer and or financial planner to basically tell you that it's very scary and there's consequences if you don't pay your loan. Anyway, we'll move on to the next dot point. You do need a cash deposit. You can't use equity in another property to then buy a property with your SMSF. And then the other thing is you cannot borrow for construction costs unless it's an off the plan purchase. So yeah, there's a complex rule with borrowing in super that says you can only buy a single acquirable asset. Now, what that means is that if you go and buy an existing house and land, let's say it's already built, you'll have a single contract for that. That'll be for the house. It'll be together, and that's fine. That's a single acquirable asset. But there's situations that have happened where there actually hasn't been a single asset. It's been two. An example of that would be a house and land package that has a build contract separate to a land contract. Now, that doesn't meet the requirements to borrow in super. So we need to be careful with that. But if you had an off the plan house and land package from a developer that it came fully built and there was only one contract, we're good to go. Again, one of the rules that doesn't really makes too much sense to me. But yeah, you can get the outcome if it's a single contract. The other thing that was happening, but they've, at least in Queensland, it's pretty ordinary now, is if you buy an apartment, sometimes in other states, there was two contracts, one for the apartment and one for the car park. And I know that sounds, again, a stupid example of things, but that doesn't work because it's two assets. It has to be a single asset. If I go to that apartment and car park example, there's no reason why you couldn't borrow for the apartment itself separately to having lending against a car park separately, but you'd have to have two loans, two bare trusts, paperwork. It's just stupid. Again, who knows why, but we've got to deal with it and need to be careful that that's the outcome. Alrighty, let's keep going. Deposit required. Yeah, again, it depends on the lender, the postcode, the asset type, the price you're paying. But we see lending that goes up to 80% with super funds. But yeah, there's some that might only go to 70%, sometimes less, depending if it's higher risk for the bank. But often we see 20 to 30% deposit needed plus stamp duty. And then there's also, I haven't seen too much of this recently, for clients, but sometimes the banks were needing 10% of the value of the property in liquid cash after the transaction takes place to be okay. That's to pay the bills and pay the first few months of the loan, and rather than just relying on instant rent or having to top up with super contributions. So yeah, again, I haven't seen that for a while now, but maybe a requirement depending on what you're looking for. And again, yeah, this isn't credit advice. Talk with a mortgage broker if you do want to get more info or get a scenario done up for you. Alrighty, next topic is insurances. So yeah, the three main insurances that that sort of falls in the realms of that financial planning space is life insurance, TPD, and then income protection. Now, some of these can be paid from super, some of them can't. But the benefits of paying insurance from super is that the bill gets charged to your super fund, so it's not coming out of your personal pocket. It's tax effective if it's tax deductible to the fund. The bad thing is it reduces your super balance, and you got to weigh that up. And then payment made to the okay, yeah. So if let's say you've got life insurance in your super fund, and you die, then the payment for your life insurance will be paid to your super fund and then be dealt with under the rules of your SMSF. Or I'll get onto a bit shortly about a finding death benefit nomination. Alrighty, incapacity planning. Yeah, so okay, the scenario about life insurance and dying, but what if you get to a point where you can't make decisions for yourself? And again, we don't see this often, but this happens. We've got a client where one of the members of their SMSF is actually passed away now, but for quite a while wasn't able to make decisions for himself, and unfortunately, too late to make a new will or have an EPA put in place. So just makes it hard. So really encouraged to get all this sort of stuff sorted. But yeah, the super yeah, sorry, I'll go back a step. I'd encourage everyone to have members of SMSFs, but also generally to have enduring power of attorneys in place. Um, and one of the reasons is a super fund requires all members to be trustees or directors of the company that acts as a trustee of a fund, which means, if you were to become incapacitated, then ideally you need someone to step in and be able to make the decisions for you. Um, cool. And then you also need to consider what your self-managed super fund deed says in the case that you are incapacitated in some way. Alrighty. Next one is estate planning. So, yeah, I'll sort of talk generally to estate planning and then we'll go SMSFs. Estate planning is not just doing a will. And I say this more for business owners. That's my perspective. The reason is if we've got companies or trusts or SMSFs, each of the assets in those entities is dealt with differently. And, a will only deals with assets in your name. So again, we need to consider way more than just a will. Now, if we look at superannuation, your superannuation balance after passing can be dealt with by binding death benefit nominations. That's a bit of paperwork that you need to do to basically say where your super balance goes to. If you don't have one, it's otherwise dealt with the trust deed. Now, if you don't have a binding death benefit nomination to a person or anyone, often we see the proceeds ending up in the estate, which would be dealt with under that person's will. But again, it's very reliant on what paperwork is in place at the time and also what the trust deed says. Yeah, I'll sort of mention this, that it can be paid to the estate, but it's not guaranteed. The other thing I sort of hear from clients is that, I don't have much assets, or I don't have much in super. I don't need to do a BDBN. But if you've got life insurance that's held in your super fund and you die and your life insurance pays to your fund, let's say it's $1 million or 2 mil, then all of a sudden you have significant amounts of assets in your super fund that, again, if you don't have any instructions there, that's pretty silly. And again, there's tax consequences or potentially, if it ends up in the wrong hands, it could be very quickly diluted, the wealth that you've built up over your life, rather than being passed on how you want it to be passed on. Oh, I might just stop for a sec and we'll go to the chat box because there's a few questions that have popped through. If you have investment property outside super, can we transfer to an SMSF without transfer stamp duty? So Liz, you cannot transfer residential property into super, but you can transfer commercial property into super. And I'll give some examples of that shortly. But we can't get out of stamp duty because every state we've had a transaction in wants to clip the ticket, even though you're selling it to yourself or as part of your family assets. It's pretty lame. But that's I think there's some exemptions in some states depending on where the asset is originally owned. But I'd just be expecting to pay stamp duty on that one. Get advice for your specific circumstances. That one. I've already answered John's. How is the tax treated from investment property loan to super? So Marcus, you might need to help me out here. Is that if you lend your own SMSF money? Yeah. Okay, cool. So we've got a bucket company, it has a pot of cash, and you've lent your own SMSF money, and you've got to charge it interest. There's requirements for related party lending. So what we see is a tax deduction to the super fund for the interest it pays to your bucket company, and then the bucket company would have to pay tax on the interest it earns as an investment, basically. Does that answer the question? Sort of. Okay. All good. We can dig into that. Already, Peter, when borrowing cash from your bucket company through a bare trust, is Bitcoin considerable and an allowable asset to purchase? Haven't had that example yet, and I would have to check that, Peter. Not sure on the top of my head. It sounds like a single acquirable asset. and like, let's take ASX listed shares, because you can borrow to buy shares, but it has to be a parcel of the exact same share. So you could buy 100 BHP shares or 100 of a managed fund that has some diversification in it, and you could leverage against that with a bare trust. Yeah, I just haven't had the example of Bitcoin. I don't know whether there's special rules related to that off the top of my head. Alrighty, case study number one, the vet from the bush. Alrighty, so the example here is he held a commercial property outside of super. It was valued at about 300 grand. He had a loan, so the structure of his finance for that was that it was like a 5-year term from the bank, and then they basically take the lending off him, not like a 30-year loan we see on resi property. Anyway, loan was coming up for expiry, and he had enough in super. It was just over 150 grand. So he was able to pay the loan out with his super balance, and pay the stamp duty to get it into his SMSF. And what happened is, if you're in the shoes of the SMSF, you've still got to pay market value for this asset. So 300 grand plus stamp. But there's a difference of ballpark 150K that the super fund needed to borrow. Now, he borrowed that, the SMSF borrowed that from the outside of super entity, call it a bucket company for simplicity. So what that means is his SMSF owed him outside of super 150K for the purchase. Now, how that works, it just needs to be paid back over time, minimum repayments with interest. But how that works to actually pay the loan back is, let's say the normal contributions he makes each year, let's say the 30 grand tax deductible ones, he puts that into his super fund as a contribution, and then his super fund repays that loan, the loan from the property back to him. And so from a cash flow perspective, it's 30 grand in, call it roughly 30 grand out. And yeah, there's no tax on that loan repayment. There's tax on the interest, which we covered with Marcus's example before. But yeah, it's quite great. Like it's a great scenario when we've got these situations with clients. Alrighty, case study number two, W Super Fund. What happened with this client is he had a commercial property outside of super. It was worth about $1 million. The client was shifting into retirement, and he wanted to move money and assets into super. He decided to move the commercial prop in. In his SMSF, he had about $300,000 for a deposit, but he needed 700 grand or so from the bank. The last stop point here isn't really relevant, because you could do it if the client occupied his business or not. In this case, the client didn't occupy his commercial property. So in the SMSF, he received rent for a few years at 0% tax because it was in pension mode. About 3 years later, he received an offer to buy the property for about 1.3 mil. Because he was retired, paid no tax on the gain compared to, call it 30% tax outside of super. And what that meant for the fund is that, a few years before had about 300 grand in super. Now we're looking at 600 grand or more based on the rent received over those few years as well. An IT business from Melbourne. So the business was previously renting a premises and had grown through COVID. The owner had an opportunity to buy a commercial property near his house. And this is one of the sort of like warehouse sort of scenarios with a mezzanine floor up the top. Purchase price was about 300 grand. The property needed a bit of work, a bit of fit out, which was, so how we funded that, the fit out, was actually that his business prepaid some rent. And then he used that prepaid rent to go and deck out the property. The furniture and fittings were paid for by the business itself to access the instant asset write-off while we had it. And then the client is now paying a similar rent than what he was in the previous property, but he's paying it to himself, which means that his rent expense is actually building his own wealth. All right, next example here. We had 4 business partners buying a property. And in this instance, they all had SMSFs. They all had at least 200 grand in cash ready to go. And the property they were looking at was 750 grand. So what we did there is used an ungeared unit trust. So the SMSFs each purchased 25% of a unit trust. And then that unit trust bought the property with no lending on it. But again, there's another type of trust we can use where if you've got unrelated parties, let's say there's 4 business partners like this, we can even borrow, or there's banks that will lend to a certain type of unit trust that is owned by superannuation. And they're sort of pretty hectic examples, but it is possible with the right setup. Home office to premises. Cool. So this was a service business in the building industry. Yeah, one of those ones that had grown pretty rapidly through COVID. The client had an existing home office with team coming to their house every day, and they had a baby on the way and were a bit uncomfortable continuing that sort of arrangement, especially as the team was growing. The client purchased a commercial property a few minutes down the road. 800 grand, 75% LVR. The property needed renovations, which was funded from excess cash in the super fund. So this client had more cash in his super than he needed to make the 25% deposit plus stamp. The furniture paid for by the business for the instant asset write-off. And then the client now has a lovely shop front to take him into the next stage of business growth, and has increased the valuation, from my understanding, substantially, also thanks to the market increasing through the renovation, but also that market movement. Cool. Alrighty. So we're going to shift into more questions in a moment. But if you do have any questions for further from this, or you want to sort of have some more information about setting up an SMSF, if you're not a client, then the best way to do that is to book a strategy call with one of our accountants. If you are a client, though, reach out to the accountant that you work with at Inspire, and then we can have a chat from there. But we are going to shift into Q&A. Now, on the screen, I do have a few questions that were asked when you registered. There was a box that said, if you've got any questions, what are they? So I'll pop those up there, but I'll deal with the chat box first. Alrighty, so Peter has asked if I currently own Bitcoin outside of SMSF, purchased by a trust. With scenario 2, sorry, mate, I don't know which scenario you're referring to there. But with Bitcoin, or any assets that aren't commercial property or ASX listed shares, we can't actually sell them from outside of super into super. So there's a blanket rule that says no transfers between outside and inside super, unless it's commercial property or ASX listed shares. So yeah, not sure exactly what you're looking to achieve, but we do have clients also with crypto portfolios in their SMSF. That's fine as long as we meet all the requirements and the investment strategy considers it. Liz S, looks like SMSF is beneficial mainly for commercial property. It depends. We've got clients who own businesses through their SMSF, residential property. It all depends on what the client's looking to achieve. There's really cool benefits for commercial property, especially if you're in business and you're the tenant. Sanjay, I've got a commercial prop valued, purchased at 450, now worth 700. Very good. Awesome. Sanjay, is it worth to buy through SMSF? Yeah, I think with exact examples like that, yeah, I feel like getting advice around that, or what the outcomes will be, is the best next step. I'm guessing you might have the commercial property outside of super and you're considering potentially putting it into super. Yeah, I mean, it can happen. I've just shared the case studies on that, but it'd be worth, cool. It'd be worth just getting some advice around what the implications will be, what lending looks like, what your current balance is. That's all very relevant things. Alrighty, first question on the pre-ordered question list. Does a property need to be neutral or positively geared to be in an SMSF, or can it be slightly negative? The answer to that is no. There's no requirement for a property to be positively geared or cash flow positive. If it is negatively geared or cash flow negative, I would just keep in mind, how are you going to pay the difference? Is it with contributions from, you or your spouse's annual contributions each year? Is the rent going to go up soon? I don't know what the thing is, but what I would be just making sure is, can you actually pay the difference if it is negative cash flow? Next question is, what is the criteria to start an SMSF or run one? So loosely, you can't be a disqualified person. I think that includes people who bankrupt, done naughty things, etc. And the question around criteria is usually, what's the minimum balance? Like that's if no one's asked that already, I reckon the question might be coming. Now, if you Google that question, Google would probably say 200 grand or 250 grand, somewhere between that. But my answer to that is, it depends on what you want to do with it. Like, we've had clients who wanted to buy their commercial property that's only worth 150 grand. They might have only had 70 or 80K in their super fund, but their priority was securing that property to have their business in. So yeah, there's no hard and fast rules. Obviously, the less that you have in super, the more that the setup fees and ongoing fees will be as a % of your balance. And then the last one there is, what are the ongoing accounting costs? Yeah, it depends on what your SMSF is invested in. If it's more complex, we charge more for that. It makes sense. We don't have a fixed rate for every single SMSF, but I'd expect it to cost you about 3.5 grand, maybe more, each year from an accounting perspective, and that's without all the other costs of running an SMSF. Bank fees if you've got a financial advisor on it, that sort of thing. Alrighty, back to the chat box. Can you buy a commercial prop in an SMSF and live in it as a main residence? No, that is naughty. That is a breach of the sole purpose test. Yes, the ATO would not like that. John Bellamy, if you have a lower balance but want to build cash flow inside of super to then purchase a property later. Yeah, I'm assuming, yeah. So I might reframe it how I heard it. Want to buy property sometime down the track. My balance isn't probably enough yet to warrant the property purchase, but I want to start putting it away. You've got two options. You can set up an SMSF and start dumping cash in there and building it that way, or you can keep your super where it is. I just make sure you get a financial advisor to review where it is, look at fees, and you're not getting hugely eroded by that. But then pump your contributions into your existing up until the point where you're ready to buy a property. The thing is, if you go and set up an SMSF, you need to manage what it's invested in as quick as you can, because what will happen is you'll roll over your existing funds, and that comes in cash into a bank account, and then it's up to you to do something with it. So, for me, I wouldn't want to roll over my balance and sit it in cash until I'm ready to buy a property. I'd want it invested between now and then. Clear strategy in play. Yeah, cool. Awesome. All righty. Well, that covers everything that I had to cover, with a few questions in there. And I think that might be about it from my end. And if there's no more questions, we might wrap up the webinar there. But I just want to thank everyone for joining. Appreciate it. Appreciate the interaction, and thank you all the bonus points for the people with the webcams on. Makes me feel like I'm in a workshop, not just talking to a screen. So amazing. Alrighty. Well, hope everyone has a great end of the week, and I'll pop some